Resilience meets strategy. Welcome again for FYAP Securities and 2Trade Asia's annual outlook for 2025. Let's begin. Among the 30 stock index basket, 60% registered price gains, with 9 out of 18 gainers clocking in double-digit growth. Lead gainers were Converge as 9 months earnings rose 29% on the success of its FiberX rollout. ICT also on 9 months consolidated earnings improving 31% on good TEU growth for Asia and emerging market in East Asia. Metrobank, Century Pacific Food on its selection of new distributor partner for China operations, and BPI. Meanwhile, nickel fell as 9 months earnings declined by 35% on softer metal prices and output. JG Summit on additional capital for its petrochemical business. Bloom given the weakness in 9 months VIP table segment with the Pogo exit, and Wilcon on slower traffic in legacy stores plus higher expenses from network expansion. Under all shares, RCI rallied more than fivefold on the planned development of 3 haciendas in Batangas but was countered by reports of unsettled property taxes. ABG's ascent rests on the rumored backdoor listing of Okada Plus's 9 months results jumped 314%, plus the online license approval in Brazil's e-gaming market. Among decliners, APL led the retreat with the stoppage of drilling activities due to rising tensions at the West Philippine Sea, KEP, Upson, and Bright Kindle. For new listings, 2024 had 3 IPOs for Oceana Gold, CREC, and NextGen or XG, all finished with double-digit gain compared to their listing price. Real estate investment trust shares had a spectacular run with double-digit price gains from PREIT, RCR, PhilREIT on its property dividend with parent firm FLI, CREIT, and AREIT. In terms of net foreign funds flows for the index basket, net foreign buying was visible for banking shares BPI, Metrobank, and BDO, holding firms SM and GTCap, and energy names Meralco and ASEN. Among telcos, net foreign buying benefited Globe, Tel, and Converge. Net foreign selling was seen for property shares Ayala Land, SM Prime, and holding firms AEV, JG Summit, and SMC. For all shares, RLC, Manila Water, SSI, Macro Asia, and SPINEC had net foreign inflows, while AP, RRHI, and MEG had net foreign outflows. For share buyback updates, market prices of SSP, URC, and AEV are trading below their average acquisition cost per treasury share, while those in the premium include Price Corporation, Concepcion Industrial, and Costco. For our economic review, assuming fourth quarter 2024 economic growth of 6.1%, that puts our full-year GDP average to 5.8%. For 2025, our base case scenario is for economic expansion of 5.7%, while upper case is at 6.1%. The key driver is on consumption growth with the new nascent cycle of lower interest rates, translating to improved business activity and improved job generation. Fiscal spending growth will rely on the 10% increase in government budget next year to 6.35 trillion. On capital formation, 7.6% baseline growth assumption will take its cue from reduced borrowing costs that should hasten CAPEX rollout initiatives. Moreover, Create More's passage would translate to reduced corporate income taxes to 20% from 25%. On trade, the electric vehicle industry will support demand for electronics, with prospective export boosts from chemicals and coconut oil. Meanwhile, the economy is not bereft of challenges, as similar to our peers in the region, detailed tariff policies from the Trump administration is something that investors would check on. This would have a bearing on consumption growth trend as tariffs are considered pass-through charges. There are also risks associated to trade, especially on logistics issues that could affect transport routes, plus potential protectionist policies on key industrial inputs such as coal and metals. Here are the key highlights of events on a quarterly basis using our base and uppercase assumptions. Noteworthy was a total of 450 basis points rate increase made in 2022 until 2023, plus the 50 basis points cut made by the local central bank last October 2024. As earlier underscored, the new cycle for monetary policy easing has just started, and expectations are gathering momentum for continuity of this trend towards 2025. On a conservative scenario, there is likelihood for another 100 basis points reduction in benchmark interest rates depending on tariff details of a Trump administration on key imports from China, Mexico, and Canada. The uppercase assumption is for 200 basis points rate cut. Having lowered the reserve requirement ratio by 250 basis points to 7%, there could be support for 150 to 200 basis points lowering of reserve requirement pending overall trend of consumer prices. Trump held his first presidential position from 2017 to 2021. Note from the inflation trend that local inflation peaked to 5.2% when rhetorics of tariffs were administered during the year. It was during this time when Trump called on foreign imports as a national security threat that led to subsequent retaliation by trading partners. On 2024 standpoint, we see inflation averaging 3.2%. Assuming moderate tariffs are passed through and the absence of devastating typhoons, inflation is seen at 3.3% for 2025. On external spotlight, investors would keep tab on progress over climate change's impact on global food security, even as measures are being rolled out on funding schemes to help support affected countries. With incoming President Trump's stiff hold on higher import tariffs, market participants would also check on the Fed's sequel monetary policy direction and its impact on the US dollar movement. What is known so far is that the new Trump administration is seen to make permanent the Tax Cuts and Jobs Act. That includes cost recovery for machinery investments, maintaining the 21% U.S. corporate income tax, lowering of government spending to reduce inflation, and boosting U.S. energy output to lower energy prices. Lastly, geopolitical issues that could weigh on regional trade routes remain, especially on its effect to crude prices. The PSEI fetched a low of 6,158 last June 21 and a high of 7,464 last October 7, putting the midpoint at 6,800 level. Upward angles include the nascent cycle of monetary policy easing that should fuel improved consumer spending and investment initiatives, as well as fiscal rollout of infrastructure pillars that has drawn interest from prospective fund managers. Within the comfort zone of 7,000 to 7,600, PE multiples would be roughly at 16 times versus pre-pandemic peak of 22 times. Challenges, meanwhile, are set on revived trade retaliation from Trump's universal tariff policies, geopolitical headlines that could affect trade routes, and severe weather effects of climate change. 2025 is considered the year of the wood snake, beginning the 12th of February in the Chinese lunar calendar. Wood element signifies growth, positive energy with highlights on innovation and creativity. And among the sector stars are those in technology, specifically tied to artificial intelligence and robotics, clean energy, digital assets, technology supply chains, research and development, education, and cybersecurity. We revert to prospective common shares and preferred listings that were unable to materialize in 2024 and might revisit the capital market in 2025. Some of the keenly awaited include GCash, SM REIT, Maynilad, and Metro Pacific Tollways, among others.
Moving on to our sector calls, our overweight focus is on banking, consumer retail, energy, property, and gaming.
Banking stocks were generally upbeat, driven by improved NIMs resulting from the local central bank's monetary policy cuts. Lead large-cap gainers were PNB, NBT, BPI, and East West. UBP meanwhile declined as operations absorbed integration costs of Citibank's consumer group. Save for RCB, 9 months 2024 earnings growth ranged 6% to 24% for listed banking stocks, with double-digit lagged by BPI up 24%, East West up 20%, MBT and BDO each up 13%, and PNB up 11%. The local central bank's monetary policy easing led to NIM expansion of 18 to as high as 96 basis points. The sector's NPL ratio remained single-digit at 1.6% to 4.1%, with lending growth at 8% to 16%. Among banking bets, BPI's core thrust is on widening its network reach, especially with its synergies that would unfold from GCash, plus retail-based expansion via digital unit Banco. Target price for BPI is 162.75 pesos per share. MBT meanwhile will improve its core units after the sale of its 70% block in First Metro Asset Management to Atram Group, as it focuses on investment banking. Among dark horses in the sector, East West 9 months earnings rose 20% to 5.8 billion pesos as the bank adopts small yet more agile strategy through enhanced channels servicing via improved marketing and its digital drive. Another retail choice is SecB, having improved its 9-month results by 12% to 8.5 billion pesos. SecB is cheap on price-to-book value basis.
For consumer retail, liquor firms GSMI and Keeper powered gainers, advancing by 51% and 45% respectively. Keeper's 9M income improved 19% to 2 billion pesos. CNPF was also in the lead, having appointed their new omni-channel distributor partner in China, Shanghai Ekite International Trading. CNPF's 9M income gained 14% to 5 billion pesos. Figaro also rose along with Monde on reports of Monde's possible sale of its block in FCG. Monde's core 9M results also improved 31% to 7.5 billion pesos. Among decliners, Home retreated after 9M income fell 41% to 342 million pesos on slow purchases for home constructions. Similarly, Wilkin's weakness stemmed from the 22% decline in profits to 2 billion pesos on higher expenses from its new store rollout. Wilkin was also booted from the PSEI basket following February's rebalancing. Within select consumer stocks, for the first 9 months of 2024, gross profit margins ranged 18 to 40% for Monde, CNPF, JFC, Pure Gold, and Wilkin. Net profit margin remains competitive for JFC and Pure Gold at 4.6%, while AMI and GSMI enjoyed 11 to 12% earnings margin. Premium PEs are in place for JFC, Wilkin, AMI, CNF, and Monde, given their strong market position. Return on equity has been brisk for GSMI at 26%, CNPF at 15%, and 11% for JFC. Primed to benefit from the local elections in May 2025, try adding to your consumer basket the following stocks. Pure Gold will benefit from improved consumer spending, especially as the buy-in into Pure Mart would expand the firm's footprint for the low-cost retail category. JFC is a good pick with 9M earnings of up to 24% to 8.5 billion pesos with the addition of Compose Coffee. CNPF is cooking up big wins on a global scale, with export sales rallying 43% in 9M24. The company has also expanded its e-commerce footprint, effectively adapting to evolving consumer trends. CNPF is also a good angle on sustainability and social responsibility.
Within energy shares, SGP, SPC, Meralco, Alter, and VBT had double-digit price changes, while declines were visible for smaller players like Red Sea, BSC, Aslag, and STNEC. Among index players, Meralco and ASEN were on the plus side, while FGen and APIS lead. Based on the Energy Bureau's long-term energy plan, peak demand growth is seen to average 6.58% per year. Within the three archipelago, demand growth is seen to be brisk in Mindanao at 8%, followed by Visayas at 7.3% and Luzon at 6%. Meanwhile, industrial and services sector would account for 37% of total demand, followed by transport at 35% and household at 25%. The Department of Energy sees higher installed capacities from renewable energy by 2030 at 54%, followed by coal at 25%, natural gas at 13%, the balance from oil. Within renewables, solar power is estimated to account for 66% by 2030, hydro at 20%, the balance from geothermal, wind, and biomass. Among power plays, AP continues to have the highest net income per attributable capacity and cheap PE multiple at 7 times. Smaller players like CREC and Red Sea appear to have high market cap relative to megawatts, suggesting the need to further boost operating capacities. ASEN has a modest PE of 19 times, with potential boost in net income per attributable capacity once its ongoing projects go live. For our power stock calls, ASEN isn't just meeting its 2024 goals, it's exceeding them, achieving a massive 6.8 gigawatts capacity. Its latest projects in Australia are set to supercharge energy output, while cutting-edge investments in battery energy storage systems will boost reliability and grid stability. Next, Meralco, the Philippines' largest power distributor, is evolving to meet demands of a tech-driven world. We are bullish on its power generation segment, foray into renewables, and electric vehicle industry. Lastly, FGen is cheap in PE terms, and upsides will be supported by its expansion into LNG and other projects. Among energy wildcards, Alter plans to expand installed capacity from 86 megawatts to 500 megawatts by 2026. 4 major projects, collectively adding up to 225 megawatts, are expected to be completed by 2025. SPNEC, through unit Terra Solar, is embarking on its 3,500 megawatt solar farm in Nueva Ecija, paired with 4,500 megawatts peak battery energy storage system.
For the property sector, FLI led gainers up by 34% following its property dividend declaration of Philrich shares, while CPG advanced 29% with improved dividend yields with the firm's full ownership of Horizontal Township First Park Home. DD also gained with the listing of Hotel 101 in the US and opening of Madrid and Hokkaido projects. Meanwhile, SM Prime and Ali suffered declines on reduced weighting in MSCI basket. Let's take a look at the residential segment. Metro Manila's residential market continues to face challenges, highlighted by unsold inventory of 68,000 units as of 9 months of 2024. This may be due to prevailing home loan rates, especially from commercial lenders. From 2021 to 2023, estimate shows there were 23,000 units launched more than sold. In terms of residential revenue growth, RLC was flattish for 9 months due to cancellations. Ali had more than 40% growth on brisk demand for their roster of projects. For 2025, the lag effect of central banks' rate cuts should eventually support buyers' appetite for residential properties. Those with the low cost and affordable categories are seen to be supported by tax incentive under Create More. Based on Colliers data, the exodus of August brought office vacancy to 18.6% in Metro Manila. This figure, however, is an improvement versus 19.4% in 2023 and 18.8% in 2022. Looking at the office leasing earnings growth, CLI maintained its market position in Bismin, while DD suffered declines with Pogo's high concentration in the Bay Area. Meanwhile, property firms may recalibrate on office space offerings to draw in more traditional BPOs. With increasing business activity and outsourcing, support may be taken from enterprises' need for flexible office spaces, especially those with good technical support system on electricity, cabling, and work areas. For challenges, remote and hybrid work setups could weigh on the supply situation, especially as Create More incentivized hybrid work arrangement. As of 9 months, General Mall vacancy stands at 15.1 from 15.6% in first quarter of 2024 on improving take-up from retailers as consumer return to malls for leisure activities. Based on Colliers survey estimates, around 160,000 square meter of new mall space is seen between 2024 to 2026, which is seen to be met by high demand for commercial space. Most malls are undertaking reformatting, allocating smaller size or Tiangge formats to optimize on lease revenues. The challenge, meanwhile, is on alternative e-commerce platforms, which could cap on demand for physical retail outlets. In terms of mall rental growth for 9 months, MEG and RLC benefited from increased foot traffic, followed by SM Prime and Ali. Meanwhile, hospitality will remain to be a key theme for 2025 property sector. 4.44 million tourists arrived during the first 9 months this year, up by 9.73% year-on-year. This has translated to hotel operations revenue growth experienced by the country's real estate firms. Ali, CLI, Double Dragon, Jerry, MEG, and RLC each saw a double-digit increase, with Jerry leading the pack with 60% growth. Infrastructure congestion will remain to be a challenge, but enhanced transport links like improvement made in NAIA and the partial opening of LRT1 Cavite extension will add more capacity and reduce congestion levels. If things go as planned, 2025 will be a better year for tourism and companies involved in hospitality.
Here's a quick look at how REITs performed as of the first 9 months this year. While DDMPR and PhilREIT lagged on occupancy rates of 76 and 82% respectively, several maintained higher occupancy rates ranging from 93 to 100%. REITs' annualized dividend yields meanwhile remain brisk at 6 to 11%. Additionally, most REITs continued to trade at discounts to their net asset value ranging from 8 to 70%. In contrast, C-REIT trades at 106% premium driven by its strong ESG appeal. Upsides for the rest of the year will rely on new asset infusion for REITs, especially those with healthy stream of recurring commercial lease income. Within property, SM Prime's theme is reinforced resilience. Mall operations will continue to benefit from new normal foot traffic and straight beneficiary from improved retail spending. We like the consolidation of marketing trusts and initiatives under the Residences brand, which would ride well with improved housing demand and availability of flexible financing packages by virtue of its synergy within its banking group arms. Robinson's Land is on another bet given its huge discount to NAV. The stock stands to reap gains from its township expansion in key urban areas across the Philippines' metro cities. CPG's 9 months and 2024's attributable earnings surged to 113% to 8 billion pesos, given its full ownership of flagship First Park Homes. And the stock continues to enjoy strong NIMs at 17% and a return on equity of 11%. CLI is also expanding its reach to Luzon and Metro Manila markets, given its successful brisk launches for projects in Vismin. Buyer profile is 20% cash, the balance on bank or pag-ibig financing.
Within the gaming category, Plus rallied 150% with 9 months earnings advancing 320% on robust performance of its retail games. Bell was also higher by 53% after delisting Unit Premier Leisure Corporation or PLC. Meanwhile, a number of gaming-related shares fell, led by PHR on stalled negotiation with Okada Camp involving Emerald Bay Resort in Cebu. Also, the issuance of Executive Order 74 imposed an immediate ban on offshore and internet gaming licensee in the Philippines last July 22, affecting participants within the high roller category. This weighed on Bloom, falling 38% in share price terms. Gaming stocks are taking the stage with exciting developments across the industry. DigiPlus Brazil Interactive Limitada has secured a federal gaming license from Brazil Ministry of Finance and is set to commence operation by January 2025. With 14 million registered users and 4.5 million monthly active users, DigiPlus demonstrates a strong foothold in digital gaming, a key driver of its rapid growth trajectory. Bloom generated 3.58 billion in net gaming revenue with the launch of Soler North since May 2024. Its ambitious Paniman project aims to develop a casino, hotel, golf course, and mixed-use facilities over the next 5 to 10 years, signaling its long-term commitment to expansion. We put Bell on potential dark horses list. Through its subsidiary Premier Leisure Corporation, Bell holds a stake in City of Dreams Manila and operates Tagaytay Highlands, blending luxury and leisure with strategic gaming investments. PLC also applied for a gaming license to develop a new resort casino in Clark Air Base, a promising move to diversify its footprint in the growing gaming and tourism sector.
The PACI maintained a strong uptrend throughout 2024, supported by the long-term trend line established in November 2023 with key support at 6,400 to 6,557. Our resistance levels remain at 7,000 and the 2024 high of 7,600. We expect the index to consolidate in the short term before resuming its upward momentum. If we do continue this uptrend for 2025, we could see our index pass previous high 7,600 and onto the 8,000 level. Looking ahead for pluses, the lead anchor is on the Fed's policy easing, which would aid improved consumer and investment spending. Our view is for 100 basis points rate cut in the local policy rate plus potential reserve requirement adjustment of about 100 basis points. Create More should revive interest with a planned corporate tax cut from 25% to 20%. There are challenges that calls for increased vigilance that includes results from the U.S. presidential elections and Trump's policies, the extent and coverage of La Niña phenomenon, geopolitical rifts in the Middle East, as well as territorial spats at the West Philippine Sea that could weigh on trade-related logistics charges. Investment opportunities expand through the actions we take to embrace innovation and the courage to overcome obstacles. For as Roman poet Virgil would put it, fortune favors the brave. That marks the end of our 2025 outlook. Thank you for listening and see you in our sequel updates.